Assalamualaikum warahmatullahi wabarakatuh and a very good morning to Professor Madya, Dr. Zaini. As for today, my group will be share with you about the analysis of the auditors' liability to third parties in Australia. My name is Muhammad Aizat Raimi and here's my group mate. Nurul Amirah, Muhammad Zakwan, Nurin Sharina and Nur Diana Nasuha. So I pass to Amirah for the introduction.
Okay. Read from the article, the research objectives are to provide a comprehensive analysis of the scope of auditors' liability to third parties in Australia. Second is to examining the current legal position in Australia, the law on auditors' liability in other jurisdictions, and will be compared to the extent of their influences on Australian law. Based on this article, there are three types of law that auditors are subject to. First is contract law. Second is common law, and third is statute law. Under the statute law, there are two acts that are said to expose the auditor to a heavier liability, compared to other countries. First is Corporation Act 2001, and second is Trade Practices Act 1974. And actually, there are few professional bodies, that regulate the code of conduct of the profession of the auditors and accountant in Australia. First is Institute of Chartered Accountants Australia, ICAA. Second is CPA Australia, CPA. And actually these two bodies have the authority to impose penalties to the auditor or accountants that breach the code of conduct of their professions. First, they can impose the suspensions of the membership, suspension of membership. Second, they can impose fine. Third, they can order for repayment of cost. And third and fourth is they can send the accountant or the auditors to attend professional course. And the third bodies that conduct the profession is Australian Accounting Standard Board. These bodies, they will regulate more standards to be followed by all the accountants and auditors in Australia. Based on this article, we will talk about the concept used. First is roles, second is EGT, third is DBT, and fourth is users. So, based on this article, the roles of the auditor is to develop a qualified audit system with effective control to guide against mistake and fraud. And second is to provide a fair view opinion regarding the compliance of the financial audit report prepared by the accountant. Is the report comply with the accounting standard or not? Third is they will accumulate all the evidence and interpret it, and form in an independent audit opinion. Why it is important of producing a financial audit report? First is for the client, to know the performance of the company. Second is the financial audit report is prepared for the shareholders. For the shareholders to know, the prestation of the performance of the company. So they will know if the company is making profit or not. Same goes to the investors. And fourth is for the creditors. For the creditors to know the capability of the companies to pay the debt to the creditors. Then we will talk about the EGT. EGT stands for Expectation Gap Theory. Based on this article, it means the different perception of auditors' role between users and auditors. Actually, the auditor has the role to give a reasonable assurance only regarding the financial audit report, and not to give a full guarantee that the financial audit report is free from misstatement. And then DPT, deep pocket theory. Deep pocket theory is the risk of an activity should be borne by a person which is relatively good position to handle it. Next, I will explain about the auditor's liability under common law in Australia. First, the auditor has the responsibility to exercise a standard of care when performing the audit for the financial or audit report of a company. Second is the test of proximity and reliance. The auditors needs to know or to know for what purposes that the financial audit report is to be produced for uh, or meaning which third party will be used for the financial audit report and for what purposes. For example, in the case of Columbia Coffee and Tea Private Limited versus Churchill, the fact involved a plaintiff investor who brought an action against the auditors for losses suffered as a result of relying on audited financial report, which had the effect of understating the company's debt. In this case, it clearly shows that the auditor has the responsibility to the extent of the third party who relies on the information from the financial audit report. Third is effectiveness of disclaimer. Let's say if the auditor found uh, guilty or negligence, okay, in the uh, financial audit report, but okay, because of the disclaimer stated in the financial audit report, this will limit the liability in relation the auditors with the third parties. Fourth is contributory negligence. This means if the apportion the blame fairly distributed among those parties for the responsible of the financial losses. This means that not only on the audit, the blame is to be on the auditors, but it has to be distributed among the management, the directors who caused the financial loss of the company. The last one is common law remedies. Okay, common law's remedy is to restore the economic loss by the plaintiff by defendant.
Assalamualaikum. My name is Nuri Sharina and we will continue for the common law. So for the common law, there are the standards of care, test of proximity and reliance, current position regarding liability, effectiveness of disclaimers, contributory negligence, and common law remedies. For the standard of care, the duty is imposed to the auditors. So in the case of Pacific Acceptance versus Forsee, the auditor is negligent in failing to inform the plaintiff, which is the client, the existence of the fraud to certain loans. So the plaintiff they need to prove that defendant, which is the auditor, they failed to meet the sufficient standard of care. Next, for the test of proximity and reliance, the Australian court restricted finding of auditor's liability by using test of proximity to establish existence duty of care. So for what is proximate relationship, which is auditors, they know or ought to have known that plaintiff intended to use information or advice for some particular purpose. So the test of reliance also has been made. The auditors owe a duty of care to third party, but the court in favor in limiting their scope of liability. This is based on the San Sebastian versus the Minister case. And then for the current position regarding liability, High Court narrowed scope of liability of auditors by denying the third party success in their claims against the auditors for negligence misstatements. And then the audit manual does not amount to an auditor's assumption of responsibility to third parties. So for the case of Columbia Coffee and Tea versus Churchill, the plaintiff they unreasonably relied on the audited information, and the court stated that they should have made further inquiries. Therefore, the auditors they did not owe a duty of care to the plaintiff. Next is effectiveness of disclaimers, which is auditors use disclaimer clauses. And then under case of Hadley Burn versus Heller, there is an existence of disclaimer in audited financial statements. This is because the courts found in favor since there is a disclaimer provisions that effective in Australia, the compliance with the statutory obligations, which is the Corporation Act 2001 and also TPA Trade Practices Act 1974. And then for the contributory negligence, the defense of contributory is available for the auditor. Under Supreme Court in New South Wales, the defendant, which is the auditor, defense is a positive move towards proportioning liability, as the plaintiff also had been accused or found negligence. So the directors also they should bear their responsibility for the company loss. This is because that will be unjust or unfair uh, for the directors to escape from the liability completely and put the full burden, all the uh, falls on the auditor to compensate. And then the last one is common law remedies, which is a damage under negligence aimed by the plaintiff to recover their loss. So if the auditor they found liable for negligence, the plaintiff they entitled to recover their loss based on the law restitutions. So if the case involves negligence of the company directors, uh, and there will be reduction or reduce on plaintiff's damage entitlement.
Assalamualaikum warahmatullahi wabarakatuh. And now I am going to further explain the core point in this presentation, which is the statute law. Okay, for your information, statute law is the reason why auditors in Australia suffer burden of liability toward third party, as compared to the other countries such as USA, UK, and New Zealand. So basically, in statute law, there are two acts that will be discussed further, which is the Corporate Act and the Trade Practice Act. This act seem biased toward the third party, and we will discuss further about this. Okay, first thing first, let's proceed to the Corporate Acts first. Under this act, there is an authority named Australian Securities and Investment Commission. So let's call it ASIC. This authority were created to administer the Corporate Act. So the function of this authority is to maintain the confidence and give protection to the investor. If the company decide to issue new securities, then they must register with ASIC first and do the audit of financial statement regularly. The Act also mentioned that the Act also mentioned the qualification, appointment, removal, power and duties of the auditors. If auditors breach this Act, ASIC that I mentioned before can create proceeding to fight those auditors. They also have the power to put penalty on the auditors based on the authors. What I can say is this commission is the first reason to point out for the auditor's liability. As I mentioned before, in the Corporation Act, they mention the duties of the auditors. So among the duties include that auditor need to give opinion whether the financial statement are true and fair to its user. Auditor must also ensure that the report must comply with the standard. It seemed to be normal actually. So what are the problem from that? The problem rise when the auditors actually did suspect the company that have breached the act but didn't notify the ASIC. So the act state that it is an offence for auditors to hide those breaches or misleading conduct but still send those financial statements to ASIC. Based on what I mentioned before, this act are the provision that provide scope of liability to the auditors. And next, before this, I already explained the provision of the Corporate Act. So let's now dive deeper on the auditor's liability related to the securities. Actually, there is an argument in this act. The act said that auditors are responsible for false statements that contain companies' prospectus, but it is still being argued because auditors' work were not directly related to the issuing of securities. Even though even though the argument are quite strong, but still auditor have risk to be liable to the third party if statement containing prospectus are misleading. So under this act also mentioned a company must not exempt a person from liability to the company incurred as an officer or auditors of the company. It is quite confusing, right? So let me simplify. The meaning from this statement is auditor cannot make disclaimer to avoid contractual liability to others such as third party. This is a burden of liability because auditors cannot protect themselves by having those disclaimer. Just now, I already explained on disclaimer, and now I will further share with you on what will happen when auditors breach Corporation Act. For your information, there is a statutory body named Companies Auditors and Liquidators Disciplinary Board. Let's call it CALDB. So the function of CALDB is to hear application that relate to auditors breach the act. The problem is when auditors are found guilty by the CALDB, they can impose penalty, cancel the registration as auditors, and restrict their conduct. In my opinion, it is interesting to know that Australia has a statutory body just to hear on auditor breach the act and being negligent. So I think it is only in Australia that have this statutory body. Actually, there is a case in 2002 which under the CLDB responsibility. So the case is NSX versus Philip Charles. So what happened is that the auditor did not provide true and fair view in the audit report. So CALDB suspend those auditors from doing practice and next impose penalty and require the auditor to attend professional courses in audit practice. I can see there is a very strict enforcement made by CLDB as 9 auditors were taken disciplinary action in the year 2002. And next, one of the concerns that might be triggered in the Corporation Act is that auditors are responsible to the public because it is deemed that purpose of audited financial statement is for public access. So this could lead to duty of care towards the public at large, and audited account are deemed to be unuseful if third party cannot rely on it. So this provide heavy burden to auditor because the liability to third party is unlimited because it's toward the public at large.
Hello, Assalamualaikum to Prof and friends. I would like to continue the presentation with the Trade Practices Act 1974. As we go by to read the article, found that federal government bodies in Australia consist of two, which one they highlight is Australian Commission. They has the authority to administer the Trade Practices Act 1974, TPA. And another one, which is the Consumer Commission, which may call ACCC. Also has the power to initiate legal proceedings on behalf of aggrieved consumers and enforce orders against parties who breach provisions of the TPA. Next, we will go down to the scope of Trade Practices Act 1974. As we all know, TPA specifically applies to corporation. In other words, it opposes to natural person due to strict constitutional limitations. As we understand that explanation by researcher on the argument due to some reasons regarding this matter, it appears that the auditing profession does not fall within the operation of TPA because audit firms prohibited from incorporations. TPA somehow does not apply to services provided by auditors as TPA specifically refers to the conduct of individuals in trade or or commerce. Okay. Which has been explained. Which is referring to S6, Section 6. Okay. Next is the TPA. Apply for natural persons where the conduct engaged involves the use of postal telephonic services. To conclude this, TPA is applicable where an auditor supplies reports to the company and its shareholders. In addition, due to some limitations, certain provision of the State and Territory Fair Trading Acts (FTA) extends the scope of TPA, which with all due respect, all legal person engaging professional services. Okay, next, we will continue with the scope of the Trade Practices Act, which which I want to highlight is on the article, page 33. TPA applies to the auditing profession and has the effect widening the scope auditor's liability to the third parties in Australia. Therefore, researchers also highlight that the TPA to application can be done if it includes Section 4B, which services are provided to a consumer to the value of 40,000 or less. Auditing services clearly fall within the definition of services provided to a consumer and constitute work of professional nature. Meanwhile, Section 52 of TPA, it provides a statutory duty allow third parties to bring civil action for damages against auditors for misleading and deceptive conduct. Various requirements for succeeding in a claim for misleading and deceptive conduct under this section. First, it must be proven that an auditor engaged in conduct was misleading. It has to be highlighted that the information is mislead or not applicable or not informative, not enough information or likely to be mislead. Yeah. Okay. Second, the test causation must be satisfied under section 82 bracket 1, in which the plaintiff must prove that loss or damage was in part or wholly as a result auditor breaching the contract, which I highlighted. The audited, in other words, audited financial reports which are incorrect or inappropriate, which will drive to mislead or deceive users, as we all know. If the information is not true, then the financial reports also is not true. Okay. In terms of the number of action brought in Section 52 of the TPA against auditors, cases have been limited. However, as third parties become more aware of the provision, there will be significant legal ramification for audit profession. Okay. What I found in the article is that the Section 52, the relevance of common law test. Okay, the benefit of this referring to Parkdale Custom Built Furniture Pty Ltd versus Puksu Pty Ltd. Okay, what they say about this case is that the plaintiff does not have to establish a duty of care and proximity of relationship as required under the common law. Okay, and the difficulties encountered by third party in establishing duty of care have effectively been removed by TPE. It thus increases the scope of auditor's liability. Next. Okay. Meanwhile, in Section 52, it states about it's in Section 52 and misleading representation of the TPA. Okay. Auditors may also liable for future representation under 51A bracket 1 of the TPA if they are misleading in nature. This section has been interpreted strictly by courts and therefore auditors must accompany any presentation with appropriate evidence and qualification to support their statement. For example, the preparation of budget, cash flows and whatnot concerning intended acquisition or disposals. Okay. Second, burden proof lies on the defendant to prove that they were reasonable grounds for making the presentation. There has not been a definitive case brought under 51A, Section 51A against an auditor misleading future representation. In addition, we would like to highlight on the implied warranties under Section 74. First, it relates to consumer transaction for the supply services. This provision effectively implies a warranty into all contracts between an auditor and the company engaging on its services, which in addition, statutory is imposed upon the auditor to perform services with duty and skill under Section 74 of the TPA, which this is the applied warranties. Okay. Second, a further warranty is implied in relation to the provision of auditing under section 74 bracket 2, which states that any material supplied in connection with the services must be fit for the purpose for which they are carried out. Okay, thus auditors will only be able to escape liability under this provision if it's proven that a consumer unreasonably relied on auditor's skill or judgment. Meaning that if they are relying on the auditors in total, then the escape, the loophole will be positively be done. Okay, so I will be giving. I will pass it to my friend for continue the presentation. Thank you.
Assalamualaikum. My name is Nuri Sharina and I will continue under TPA Trade Practice Act 1974, which is a legality of disclaimer under Section 68, availability of contributory negligence, enforcement and remedies, and also recent cases against auditor in Australia. For the legality of disclaimer under Section 68, it's about application of divisions to contract not to be excluded or modified. Or in a simple word, Section 68 is about void of contract that restrict or exclude or modify the operation of Section 74, which is under warranty. And then the auditor, they have the right to use disclaimers while providing services in order to limit their exposures to liability. However, the disclaimers, they must be not contra with the section of the TPA itself. A breach to this section will result to a breach of a contract. So the auditor uh, also retain the right to specify the extent of their duties, such as providing appropriate, clear, and prominent warnings and also qualifications. However, the auditor, they cannot fully remove the responsibility for the from the performance of the services, because the clauses will not effective unless there are compliance with the requirement under the TPA itself. So for the availability of the contributory negligence, both auditor and company, which is both parties, there might be contraventions, the TPA, the Trade Practice Act, if they engage with the misleading and deceptive, which is under Section 52. So the both parties, they might have a chance or high chances to engage with this section. And then non-provision state contributory negligence available as a defense. So as for now, according to TPA, there are no other provisions, official provision that state that contributory negligence can be used as a defense. For the relevant authority, which is example of the case, which is Parkdale and Custom Built Furniture and Putsu, which is the Parkdale is the owner, the plaintiff of the lounge chairs. He accused that the manufacturer Putsu, the defendant, for misleading and deceptive under Section 52 while selling, offering, and dealing regarding their lounge chairs. So for the result of this case, the plaintiff, they fail to take reasonable care for their own interests, and at the same time, the defendant also, they unable to argue for their contributory negligence. Next is enforcement and remedies, which is a third party they seek damages under enforcement and also remedy of part 6, which is auditor liability of the Trade Practice Act. So for the remedies is under a few section, which is section 80, injunctive relief, section 82, person who has suffered the loss, to recover that loss, they need to get from the person that breaching the provision. And then under section 87, which consists of refund of money, variation of contract, and also the cancellation of the contract. The third party, they shall show that the auditor's view on the financial statement was not properly held. Next is recent cases against auditors, which is the cases of Mr. McMahon and Stengold and Ors, which is the plaintiff, Mr. McMahon, that he concerns that the sales of his business that supply motor vehicles paint protection service, And then the defendant, as the result, the defendant had been accused under a few section, which is section 52, misleading and deceptive. The accountants made a certain representations about the nature profitability of business which is misleading and deceptive. For the section 68, ineffective disclaimer, which is they are attempted to exclude the accountants from liability for loss suffered by person relying on their representations. And then for the contributory negligence, they have been accused because they're allowing figures that they have not checked to be presented to the public as their own. And the last one, the defendant being accused under Section 75B and were liable in damages, which is applicable for both directors of the defendant's company and accountants as well. And they were charged under Section 75B and they were liable in damages.
Assalamualaikum. I'm Diana and I will talk about the comparison of auditors' liability in Australia and New Zealand. In terms of standard of care is a duty imposed on auditor to exercise reasonable skill and care in auditing a company's financial statement. In Australia, third parties should have proven that an auditor has acted carelessly in failing to meet the sufficient standard of care in order to make successful claim in negligence. But in New Zealand, auditor owe a duty of care because third parties would rely on the audited information. As for the auditor's liability, the auditor's liability represents the legal liability that is assumed when the auditor is performing professional duties. Initially, restricted the findings of auditor's liability in relation to third parties, but now Australia auditors liable to third party where there is an assumption of responsibility. Auditor owe a prima facie the first impression duty of care to third parties in New Zealand. Next will be the contributory negligence. It is a defense used by the auditor when he or she claims the client or user also had a responsibility in the legal case. In Australia, contributory negligence happens when an auditor failed to meet the standard of care required. But as in New Zealand, auditor did not take reasonable care in preparing the audited financial statement. Finally, is the test of reliance, being when an Australia auditor make a statement with the intention of inducing third parties to act in reliance thereon. But in New Zealand, auditor must know the purpose the audited statements were prepared. A suggestion for limit the auditor's liability is by the auditor to get rid of high-risk clients and troublemakers. Continuing to serve clients that are risky, that require constant hand-holding, that are incooperative, or that argue over the fees, limit productivity, and often creates a crisis-oriented culture. It also builds a client portfolio of less than quality clients and increase the likelihood of lawsuit. Next will be to make sure in-charge accountant and engagement leader know what they are doing. Due to employee turnover, business growth, or other reasons, staff personnel are frequently promoted to these leadership positions without adequate experience and training. The strongest defense against the likelihood of performing substandard work is the knowledge and experience of in-charge accountant and other engagement leader. Training investment are the best malpractice insurance. Besides, auditor must preach professional skepticism. Excessive familiarity can diminish professional skepticism. Auditor must be taught how to develop a questioning attitude and to maintain a high level of professional skepticism on all engagement. Familiarity with the client can enhance professional judgment. Lastly, will be the restrict the use of report in high-risk circumstances. Normally, restrictions on the use of report are appropriate when the accountant or auditor has concern about unqualified or unauthorized persons utilizing financial statements and footnotes. For reports on financial information in specialized industries and for the other high-risk circumstances, professional liability can be reduced by restricting the use of audit, review, or compilation report.
In conclusion, overall, the auditing professions in Australia have faced heavier liability compared with other countries. Uh, it is because of they have to bound with many statutory law. Okay, for example, like ATPA, and then there are many bodies that govern this profession. Okay, for example, like ICAA, CPA. Uh, the auditor face a heavy liability due to this. Uh, actually, all the case arises has been linked to the acquisition of this professional negligence and breach of statutory obligation. Uh, for example, like in the case of Enron, okay, so this is eye opener for many companies. Okay, when they uh, face loss, okay, due to reliance of the financial audit report, okay, they will track the auditors in the problem or in the case. Okay, the purpose to reform the auditor's liability actually will help these professional bodies to limit their exposure to litigation. And lastly, okay, the roles and responsibilities of the auditors should be well informed, okay, by various related party in order to uh, help or to protect this professional body to face more litigation or in the future.